trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels. Stu, it's that time again. Coach's Corner. So one of our favorite things to do, Stu and I just love to coach people, but we love to coach not of here's what we think is going to happen and here's our 2 cents worth, but to show you a lot of math, or at least the methods behind the madness of why we tell people this is a good route to take, this might not be such a hot route. And today that fits that theme perfectly because we've been hearing this a lot in our Q&A classes. And so this is going to be a fun one. It's going to be very enlightening, I think, for a lot of people. We touched on it very briefly in a couple of the Q&As, but we really wanted to do kind of a full discussion of it. So here's our question for today. I know you're going to know what this is once you see the question. If you trade high volatility options and you have profits, is it a sign of skill? In other words, you're trading these 50, 60, or 100 options, implied volatility or more, and you go, look, I've got 10 in a row. I must be detecting some kind of a pattern here. I'm a trading genius because there's no way you could get 10 in a row. And the question we want to ask, is that really true?
Yeah.
So for all of you out there, kind of what does your intuition tell you? 10 in a row, 10 coin flips in a row would be very rare. And here you've got 10 winning trades in a row. And people say, that's a sign of skill right there. Okay, so think about that. We're going to come back and answer it at the end. And so the topic that we want to address here is, can high volatility hide risk? Or conversely, can you hide in risk and look like a Wall Street whiz when it's nothing more than just noise? Or if you're in high volatility, is that going to expose you more quickly? And that if you really think about it, it's kind of a difficult question. You would think that the high vol would expose you quickly and that you'd end up with these massive losses sooner if you didn't have an edge. So what's the answer here? Well, let's go find out some more. So high volatility. Traders think that high volatility stocks, I'll get there, will win or lose faster than low volatility stocks. That's the mistake. They go, if I'm trading high vol, it's either going to quickly reveal itself that I've got a loss or quickly reveal that I've got a winner. And because I've got all of these winners, I must be onto something here.
And a little side note here, high vol is a lot of dollars, and people are generally afraid of the, here comes the air quotes, data on those high dollars. And they look to get rid of it. Let me do the spread, let me trade it off. And it's when you really think through it, you're really trading off what you're trying to be in the
what,
first
what you're trying
place.
to be in.
It's
Right.
just, it's the opposite of what you're really looking to be involved with by giving it away to somebody else.
And that's a
It's pretty
fabulous
interesting.
point. And one of the reasons that we tell people it's most of the things that you think you see in this game, in the options world and trading, are illusions. They sound good, they actually sound quite logical, but when you break them down, you'll see in many cases it's exactly the opposite.
Yeah,
And
especially towards like the end, towards the expiration
yep,
when they they're thinking like that, oh my God, it's going to go off the cliff. I got to get out. I got blah, blah. And that's where you want to be. That is where you
that's when
want
the
to be.
options
That's what you're
resolve in.
paying for.
That's
That's
why
the
it's high
ticket you
gamble.
bought to
That's the
that
ticket you bought.
train, and you're saying, nah, I don't really
Yes.
want to do
Yeah.
that.
So anyway, this is kind of the starting premise. This is what people think. If I'm trading these high vol, they're very dangerous, but because I'm so skilled, if I go in there and I start locking in profits, the only explanation is skill. And we want to find out if that's true. Well, remember what volatility is. Traders call it volatility. If you've taken a stats class and managed to stay awake, they call it standard deviation. It is exactly the same thing. It's exactly the same thing. So if you have a large standard deviation, think of your bell curve, it's getting shorter and wider. And that's just saying there's a lot more possibilities. Same thing with high vol or high standard deviation, take your pick. You're saying, okay, this $100 stock, if it's a low vol stock, might go from 95 to 105 in this time
Yeah,
period. But under high vol, maybe it's 80 to 120.
yeah,
Even though it's got the same current stock price, you're just saying there's a bigger range, up
bigger
or
range.
down.
Yeah.
So that's what we're talking about with high vol, and we're going to find out that's where the
And Bill, isn't that what the options are doing their very, very best to try and price that range?
that is exactly what they're pricing. Correct.
But and people get it, people don't really get, I think for the most part, people don't really get that these options are high. Well, why are they high? Well, they're high because it's got a big range.
Because it's got a lot of dollars hiding in it
So you
potentially.
want to play that game or you don't want to play that game.
Correct. Yep. So anyway, this is where we're going to find out where the mystery lies and where the misperceptions. Okay. So it starts with this idea of high volatility. But what we're going to show is that bad ideas can generate profits for a long time if you are trading high vol. So again, it's kind of a paradox. You think, wait a minute, if you're in high vol, it should instantly expose you if you're on the wrong side, or instantly expose you if you're a trading genius and you actually picked up a signal. And it's not, it's exactly the opposite. So before we dive in further, you know where we're going here. A quick reminder, marketrebellion.com/get started for more topics just like this, videos, articles, lots of things to help you get a really good firm foundation in options, not all of the noise, since that's our topic that you hear so much about, what Stu and I collectively call the YouTubers out there, people who have traded options on their own and they say, okay, now I'm qualified to teach. You got to get a firm foundation. So here's a good example. And we use this a lot in Miami. I love using roulette because we could look at bell curves and talk about standard deviations and means, and people go, oh my God, this is so complicated. It is exactly the same thing. This is just a picture of a bell curve. We're saying we have different possibilities and there are different payoffs. There are different probabilities. It just gives us a nice visual. So if we look at roulette, for the US, we have 38 spaces on the wheel, and then Vegas offers these different bets. Now, there's a lot more than just these, but it's just to make the point that a single number pays off 35 to 1. So for every dollar you bet, they pay you 35 bucks. You could do a corner bet, which is 4 adjacent squares, 8 to 1, so on. But down here is the red black. Roughly half the numbers are red, roughly half are black. So it's a 1-to-1 as if it were 50-50. It's not quite, that's the casino's edge, but they pay off $1 for every dollar. Now, right off the bat, sometimes people say, well, wait a minute, this is a better risk reward ratio. I'm only risking a dollar, but I get 35. Nope, that's a pure reflection of the risk. This is a low probability, so yes, it's going to have a higher reward. This is, again, roughly a coin flip, so the reward is lower.
When you ask yourself the right question, which is the real problem most of the time, is
Yep.
what we see in Q&A, right, Bill? People just don't ask the right questions. So when you ask yourself the right question, which is, well, what's my chances of winning that 35 to 1 bet?
Yeah,
Uh,
very low.
it's really low. I mean, you have to say to yourself, there's 36 spaces, and plus the other two, the green ones, right? 38. What's the chances of
38.
winning on one number? You gotta just have common sense and say, hey, they're pretty low, which
It's a low
which
probability
then
bet.
leads to, well, that's why they're 35 to 1.
Yep. And that's a good point. That's keep hanging on that thought. It's a low probability, and we're going to find out that's where the kind of the paradox lies. So if you're playing roulette, you're going to be looking at this board, and you can see all of the bets. We can lay our chips on any single number. You can do these columns. They pay 2 to 1. This is the first 12, second, third. You can do odd or even numbers. You can bet on 1 to 18, 19 to 36, or red and black. Now again, you can see roughly half of them are red and black. We do have these two greens. That's where the house edge lives. But if you wanted to bet on a single number, so you wanted to bet on 8 right here, you just lay your chip right there. If it lands on 8, you're going to get 35 to 1.
Exactly.
But if you want to do the red black bet, just put it right there. Let's say on red.
Yeah.
Now you've got a high probability. But now the question is,
So let's just stop 1 second. So
uh,
high probability. What does that mean, everyone? So it's either black or it's red. It's like the coin, right? It's either heads or tails. There's not 35 different ways or 36 different ways or 38 different ways to win or lose here, right? It's just black or red. That's
red or
it.
black. Now, again, even though they pay 1 to 1, it's not quite, well, you've got 18 out of 38 ways to win. So it's a little bit less than a
Tiny bit.
50-50,
Yeah.
but still pretty close. In the short run, that's going to be the way to go. And again, this is where we're going to find the paradox lies. So what we do, we have to say, all right, we shouldn't just look at the reward. We need to say, well, what's the probability? What am I facing here? This is another thing that traders miss. They'll say, oh, I can get 35 to 1. Let me bet there. Or let me go for the high probability. Let me bet here. You're not done. You're just starting the analysis. So if we go and we look at at least the bets that I showed, there's a simple calculation we can do. We can say there's 1 out of every 38 times you're going to win. We just take 1 divided by 38. We multiply it by the $35 reward. Then we're going to add to it the 37 out of 38 times that you're going to lose times the dollar that you bet. And if we multiply these out left to right and then add them up, look at that, we get minus 0.0526. That's telling you that you are losing about 5.25 cents per dollar that you are betting.
Wait a minute, wait a minute. So you're saying if I stay there all night, every $100 I bet, I'm throwing $5 in the trash
That
can?
is, and in the longer you stay there, the more that's going to be more accurate. That's going to be. That's correct.
Well, how do you count for I'm having fun?
You don't, and that's actually a very good point. Yep, that
But see,
is a
that's
very
what it
good
is,
point.
guys. I mean, I'm being an idiot here, but it's entertainment. You
That's the
can't.
price.
The
That's the
point
price of
is,
the entertainment.
you
Yep.
can't expect to win. That's it. It's expected value. You
Right.
can't expect to. You might win. You might get lucky. You might have a good time. You might laugh all the way to the bank. But if you stay there long enough, you're not going to win.
Right. But we have to kind of assume in the financial markets, people aren't there. Oh, this is fun pushing buttons. I'm just having fun. I don't care that I'm bleeding out my account. I'm having fun. That's not the way that most people treat investing.
You would hope not.
Yeah, but the way that we see a lot of people trade that it is. Now, there's
Yeah.
a 5 number bet called the basket bet. It actually has about an 8 cent edge against it. And so, as I always tell people, if you're looking for a strategy in roulette, there's only one, and that's to avoid the 5 number bet, and the rest will lose your money equally fast. They all, not counting the 5 number, but they all have the same uh, edge. It's a casino edge or a negative edge to you. So now we
Bill, can
find
I sell
something.
the 5 number bet and buy 5 of the other bets?
That would be that if it were a market, that would be the trade. That would, which we talked about that in Miami. That's why
We did.
professional traders start here, right? We don't care what the chart says because if you're playing a negative edge game, why would you want to play? Which is exactly why Vegas does give you the tote board and does show you pictures. But at any rate, let's take the next step. We're going, okay, not counting the 5 number bet, they all have the same negative edge. So the thought process that a lot of gamblers would have is if I have the same negative edge, I might as well go for the high probability. I might as well take the high probability. And now it depends. That's usually our favorite answer. It depends on how you're going to bet. This becomes critical. If you want the high probability, we don't want this edge to show up, which it will show up in the long run. But you want to make it as short as possible. You want to do it in one shot. So, example, I think we've shown this before. One of my favorite stories, this was years ago, a guy named Ashley Revell from England, professional gambler. He sold all of his, think about this, Stu, all of his possessions. And when I say all of his possessions, house, car, clothes, everything, raised something like $136,000.
Yeah,
And he
yeah.
bet it on a single spin at roulette. So what
Yep.
should he do? Should he have done the 35-1 bet? If you're going
Well,
to
it's
just
got the
play
biggest
one
payoff. I
time.
mean, that sounds cool, right? Bet $1, win
Yeah.
35.
So, okay, so here's his 136. I'm just going to, you can look it up, Ashley Revell on YouTube. But, so here's, I'm sorry, let's go back. What does he do? Puts it all on a single number, on a single color, red or black. Why? It's the highest probability you're going to get. Yeah, there's a house edge against you, but it's still the highest probability. I don't know why it seems like it takes forever for the ball to drop.
Well, there's a method.
I wish they would have had a blood pressure monitor on them. You know how long this thing takes to fall in there.
Oh my God, look at this.
You're like, well, you
I've seen this 100 times and it never gets old.
Dude, it won't drop. And it hits. Okay. So now people would say, well, wait a minute. Why did he take such a risky bet? Why didn't he stay there all night long taking the high probability bets? We're going to find out. It's a very fine line to walk. So now let's do that one. And for that answer, we are going to go to an Excel sheet here, Stu. Okay. So you're seeing the sheet now?
I am.
Oh.
I'm not.
We were seeing the sheet. There we go. Okay, so what I have here is a single number bet, and then the second tab is red-black. So this is just going to do a simulation. This is 40,000 times. We're going to do lots of simulations of 40,000 spins. So look at this, right off the bat, we actually hit 30, we won 35, but we should see far more minus ones, right? And that's what we're seeing. And what this column is doing, it's saying what's the cumulative total? And that's what this black line is. It's just those numbers. So over here, I've got the standard deviation, or the volatility, as traders would call it. And we know that the average is minus 0.0526. We already found out where that came from. But the standard deviation is about 5.84. It's 110 times bigger than the average. This becomes the key. It's easy to hide in this because for any of the statisticians out there, they'll remember it's called the coefficient of variation. How big is the standard deviation relative to the average? It's massive. And when it's massive, you can hide in the noise for a long time. So it turns out if we do here's the calculations for the standard deviation. One standard deviation move, Stu, get this, 12,000. Two standard deviations, 24. Let's call it 25,000. So that should tell us that 95% of the time, that's the area under two standard deviations, we should start finding ourselves below zero at the 25,000 mark. Now, again, don't mistake that to mean that we can't be out here. That's just 5% of the time. So let's do, let's see if I can hit F9 here. That recalculated, did us another 40,000 spins. Look at this, underwater right off the bat. Let's do a few of them. All right, so here's one where we actually survived. We were in the positive after 10, maybe 11, 12,000 spins. Got into the black up here. And so you can see where traders would say, oh, I start off with losses, but you know what? I made a change, and look at this. It's coming back. See, those are all most likely stories that surround high vol. But what happens at 25,000? Not going to survive. This is another calculation that we can just say, where's our call it our survival time. And for this game, it's going to be 25,000. You're going to start to lose a lot of hope. Let's see if we can find one where we survive for quite a while. There we go, got up above. But notice we can get into 10,000 quite easy. Survive for 10. Here's one. Oh, look at this. We actually were at 25,000. Definitely beat the odds here. But at 30,000, the edge finally catches up with you. That's the point. This edge will eventually catch up with you. So
Yeah.
maybe think of
So
it as two cars that are miles apart, and the car that's behind is doing 1 mile per hour faster. They will eventually catch, but because they're so far apart, it's going to take a long time. And that's what's happening. It will eventually catch you, this negative edge, but it might take a long time. And this is part of the moral of the story for today. This is why a lot of traders can say, well, Stu, look at this. I am way up. I mean, I've got these massive profits. That might be 600, it might be 60,000, it might be 6 million. And people say it's because I'm a star trader, when it might be nothing but the fact that you're trading high volatility options. It's easy for this to happen, these profits to survive this long. All right, so let's just do a couple more.
we
Look at that.
mentioned
See, here's
that.
the downside to it. You might say, well, therefore, let me play the high vol options. Well, let me keep waiting. It's coming, and it never does. See, this is the problem of saying that you think you're going to hide in the noise. So it doesn't mean it's easy to hide in the noise. It means that it's easy to be in the noise and then claim that it's skill. So there's one. Look at this. Made it almost out to 40,000. It's interesting, isn't it? We just said 25 is going to be really unlikely, not impossible. And this is, you could see where traders are saying, this is the person that makes the front page of the Wall Street Journal and Barron's, star trader, defies all odds, has massive profit. Somebody's going
Figured
to do
out the
it.
system, has
Somebody's
like
going to do
this
it.
special signal or something or other.
Right. And
You
they'll
meant
usually have my special proprietary work is what causes this. And everybody says, oh, this is amazing.
you mentioned the word hide. Like let's just chat about that just for a quick moment here.
Mm-hmm.
So hide. Like what are people hiding from? It's like if you're in a trade that has a negative edge to it,
Which a lot of them do.
which a lot of them do, right? Which a lot of them do, then you can survive that and you
For
can
a long
win
time.
big, like really big on that stuff. But that
This
doesn't
is very
mean
common for like naked puts, out of the
it,
money naked puts. And they'll say you've got high variation. A lot of times it gets sold down to where it's a negative edge, especially after commissions. And you might knock out 20 in a row and think, oh, it's because I got it figured out because I'm using RSI. No, it's probably just because you're dealing with something that has got insanely high noise or standard deviations. And they don't realize this happens a lot when you're playing that kind of a game.
yeah. And
Now,
that could happen the other side too, right? If you're talking about like way out of the money calls, yeah, it's just
yep,
if you have 100 vol stock and you're pricing a 2 year out option that's 50% out of the money or even double, 100%, like who how can you rely on the model to say this is what that should be? I mean,
correct.
it's like the best guess, man. Like,
Yeah,
who knows? But even by the math, it becomes a negative edge. Maybe it's into the second or even sometimes maybe that third standard deviation, and
right.
it hits, and you think you're a genius because it hit. No, dude, it's eventually
It's
you
eventually
will
going
be
to.
knocking on the door saying, "How do I fix this?"
You got exactly, but they're all good points, and that's why even a pricing model asks for one parameter, standard deviation, volatility,
Hmm.
but it can't account for everything. It can't account for news or phase 3 clinical trials, which is where skews and tilts come in. It's the market's way of saying, you know what, we think we need to add a little tweak to this. And what do most novice traders do? Oh, it's trading below, it's at a historic high, so therefore it's a sale. Not necessarily. That can get you hurt. Now, let's keep the same. Remember this chart. Notice we're going out to 40,000. And we can survive out here. Why? Because of that number right there. Now, Let's go to the red-black bet. Same graph. We have a standard deviation calculation. And look at this. It comes out to be just a little bit bigger than 1. That's a whole lot smaller than 110, even though it has the same edge. So what does that mean? It means that, thinking about our car analogy, these cars are a lot closer and the one that's behind is going a lot faster. The edge is going to catch you much sooner. It's only 19 times bigger, this standard deviation. So take a look at what happens. This scale only goes to 4,000. The previous chart went to 40,000. So one standard deviation move is 365. I'm going to be generous and round that to 400. 2 standard deviations is 800. It's going to be rare that we ever get past 800. You know what? Just to be safe, let's look at a nice marker here of 1,000. Now in the previous one, we got out to 10,000, 15, 20,000. I think we had one that was 40,000. But watch how rare we ever hit 1,000. So let's hit F9. Just, yeah, you can win in the short run. But this is exactly why Ashley Revell, our friend at the casino there, said, I'm not going to stay here all night because this is absolutely going to catch me sooner. There you want to press that. You want to play the probabilities and push it to the shortest term that you can. So watch this. Look at this. Keep your eye on the 1,000 mark. Just can't get there. You can survive a little bit. Why aren't we getting out here to 25,000? Here's one. Look at right on the money. Right on 1,000. Started drifting lower. The car that was behind finally caught up. In other words, the signal finally beat the noise. And fascinating, isn't it? So the point is that it's counterintuitive that you would look and say, well, if they both have the same average, a casino edge of, let's call it 5%, I might as well play the high probability game. And I'm going to sit here all night, and therefore I have a better probability. No, you don't. You've got a worse one of winning. And this is why. It's because of this ratio. And that's really the point of this presentation. People don't consider the ratio. They either say, well, here's the probability. And Stu and I are listening. Yep, keep talking. Wait, we didn't hear you say anything about the volatility behind it. Or it's got high volatility. Okay, but we're not hearing anything about the probability. They focus on one. But again, look, I'm just going to keep hitting F9 and recalculating. Look at that. It's fascinating. It rarely gets past 1,000. And on the previous sheet, what happened? All the time we can get past 1,000. Look at that, there's 20,000. How did we survive for 20,000 spins here, but not on the previous one? Because of this signal to noise ratio. Much, much bigger under high volatility. Our standard deviation is 110 times bigger than the average, but on the red-black, 19 times bigger. And that's what's going to allow it to catch up sooner. So the thing that we're trying to show you here first is a number of points. Things that sound obvious in this game, it's got the same average, I might as well play the high probability. You could make a very strong argument and convince many people, even professionally trained mathematicians, who will say, oh yeah, that makes sense. Without further thinking about it, it's this ratio here that matters. And it's the same thing that Stu and I hear all the time in Q&A where people talk about these strategies. Or I've been selling naked puts 20 times in a row. I call it printing money because I haven't had a loss yet. Stu and I call it a matter of time. And now you know why. So let's go hit our Chalk Talk question. What do y'all think? If you trade high volatility options and have profits, is it a sign of skill? It might be, but that's not a complete answer. That statement by itself, not buying it. I would need more information or keep playing. Stu, anything to close up with?
You know, I just think it's so interesting that people like to trade, especially these days. There's a lot of volatility in certain stocks.
Oh,
And people,
exactly. All the AI
and
stocks,
people love to
exactly.
trade them, and rightfully so. That's what creates the opportunity. That volatility. If there was no volatility, there'd be nothing to trade. So you get involved in this stuff, and there's a lot of commentary on the TV and chat rooms and all kinds of places that you people listen to, and it doesn't really address the commentary doesn't address
Correct.
the idea the math behind it, the idea that,
Correct.
yeah, all right, this sounds cool, it looks cool, I can win a lot of money, but how does this relate to the chances of me winning?
Well said. So what gets posted on Facebook? My percentage win. But what you should do out there before you start clicking like is to say, hey, why don't you cough up the coefficient of variation or the signal to noise or the noise to signal ratio, I should say. And when they give you that deer in headlights look, maybe you should look to some other place for your training. So we hope that that gives you some really good stuff to think about. Stu, that was fun. We're going to see, I think, everybody else. We've got our brand new beginner and intermediate slash advanced Q&A classes. So if you're not part of Market Rebellion, please join us there. For everybody else, we'll see you in Q&A, and we'll see you next week for Coach's Corner. We'll see you then.
See ya.